Occidental Petroleum is a popular Warren Buffett stock, and the stock has been a disaster year to date. It's down 18.5%. It's been crazy. Buffett does own 29% within Berkshire Hathaway, and I did an update on it before, so I'm going to do another one. A lot of you guys enjoyed it. I'm going to talk about how the new president or how the new administration could potentially affect oil and gas in 2025, and why I believe it could potentially be getting better from here for stocks like Occidental. Now, the most interesting part is that Buffett hasn't been buying any stock. The last time he bought any Occidental shares was in June 17, and he bought at $59, $60 per share. He bought a lot of stock in the 59, 60, 56, 57, now sitting at 48, and he's not buying anything. And many people believe that maybe he's the one that's selling. But I don't think so, because we normally tend to know in real time whenever he's buying Occidental. It updates on a lot of those websites that would tell you before the 13F comes out. We likely know if he's been buying or selling. So I don't think has been the one that's been selling Occidental. And other people said that maybe because it's a large percentage of his portfolio at 29%, so he can't own any more Occidental. But he actually could, because back in 2022, he got approval to buy up to 50% of Occidental. He got like legal approval up to 50%, and he still owns 29%. So his intentions was to buy up to 50%, and he still has a long way to go. But he hasn't been buying any stock. And that's very interesting. In terms of Occidental itself, they did close on the acquisition of Crown Rock, and so far it's been amazing. It's been much better than expected in terms of asset performance, production. They raised guidance on production, and even they raised guidance for Occidental in general. So it was a good quarter for the company in terms of production, and costs have been coming down due to a lot of synergies. They've been paying back the debt rapidly, over 90% of the debt, or $4.5 billion. They just paid it within 2 months. So they've been going fast on it. They did sell a lot of the midstream assets they had for them to be able to fund the debt pay down, which I wasn't a big fan of, because I like the midstream assets. They provide recurring free cash flow that's not as cyclical as oil. But Occidental is focused on oil, and they want to be a low-cost producer, carbon capture, many different things. And this is where they're putting their focus, and they did pay $4.5 billion of debt. And this is the interesting part about Occidental that not a lot of people are talking about, because now as they paid the $4.5 billion, which was due in the near term, they don't have much due before mid-2026, which is 2.7. They have $100 million, $300 million, $600 million due in 2025. But that's easy for them. They could easily pay it off, because they still have $1.7 billion of cash. And maybe they're planning on selling more midstream shares, but they still have $1.7 billion of cash, and they're expected to make around $4 billion of free cash flow this year. So if they have $4 billion of cash flow, $1.7 billion of cash and cash equivalent, they could easily pay the debt, but they could also start doing buybacks again. And this is one of the reasons why Occidental has been a little bit weak, is because the company hasn't been buying back any stock. Even shares outstanding actually went up quarter on quarter. So they haven't been able to take advantage of such low prices and do buybacks, because their focus was to pay the near-term maturities. But now the near-term maturities have been taken care of. They have some debt due in 2025, but most of it is in mid-2026. So they still have a lot of time. They still have a lot of assets they can raise cash from if they have to sell. So they could easily not only pay the debt down, but they could also pay the dividend, and they could potentially do buybacks and maybe buy 7-8% of the market cap easily with the cash flow that Occidental is producing and at the multiples that it's trading at, which I'm going to talk about in a little bit. But if you look at Occidental, it's not just a midstream or an oil producer. They have many different technologies that are just being under the radar. For example, they own 42% of Net Power, NPWR, which is a stock that has been on fire recently, and it's a $2.3 billion market cap. They own 42% of this company, and it's mainly, from my understanding, some kind of a technology, patent technology, that uses natural gas to generate power, but it also captures 97% of CO2 from natural gas. So this is pretty amazing, pretty unique, and they own 42% of the company. This is another one, if they want to sell some of it, they could raise maybe billion and a half easily and do buybacks or do whatever they want to do. So that's pretty amazing. And they still have the DAC, which is a very popular one for Oxy. And it's mainly a longer term bet, but they are a leader in the space and they're getting grants. This is another 500 million grant in South Texas. So it's been going good for them. And it's not just an oil producer. They have many interesting technologies for the very long term. Now, looking at guidance, and this is what you have to understand, is if you're buying Occidental, you're really having some kind of a leveraged bet on crude oil. You're just betting 100% on crude oil because it's mainly, they do have some midstream cash flow, yes, but most of it is crude oil and oil and gas, I should say. And any kind of change, like $1 change per barrel, could cause a $260 million change in cash flow. This is massive swing. So it's like a leveraged bet on oil. So if you're buying Occidental, you have to have a solid thesis that oil is going up from here or it's likely going to stabilize. You're not just buying Occidental I wouldn't buy Occidental for carbon capture. I'm just being honest. This is an extra. If you're buying Occidental, especially this company, with such swings in cash flow, you have to have some kind of a construct and a strong thesis that crude oil is going up from here in the short term, or maybe it's going to stay flat because it's not the best long-term investment ever. I'm just being honest. It's like a leveraged bet on crude oil. And crude oil has been interesting. It's sitting at the same price it was in 2006. It went up a lot. Now it's sitting at $68 per barrel, which is, in my opinion, is very interesting. And I'm going to talk about the first concern for crude oil and for oil and gas companies. And this is mainly that we're going to have a new president or a new administration in the United States that's, pro-fracking and pro-drilling oil and gas. And the thesis is that this is going to increase supply, and then we're going to have more supply. And that's one of the reasons why, in my opinion, oil has been a little bit weak. Another one is China starting to recover. So this is getting better over there. But I think the main reason why oil has been coming down so much is because of the whole anticipation of a new president. And from my understanding, almost everyone is expecting 2025 to be a bad year for oil and oil and gas stocks. And normally, whenever most investors are expecting something, whenever something is this obvious that it's going to be bad because he's pro-fracking, normally the opposite tends to happen. This is what I've seen in the market. If everyone is expecting something, if everyone is expecting a crash, the opposite tends to happen. That's how we bottomed in 2022. Everyone was calling for a crash and we bottomed out of nowhere. And I've seen it happen so many times. People expect something, it's so obvious, but then the opposite happens. So this is a possibility, but I wouldn't bet my entire net worth on this possibility. But there's something else that's very interesting, is a lot of oil and gas companies have actually been donating to the new president. Now, why would they be donating to the new president if they believe that him being a president is going to be bearish on crude oil, is going to be bearish on oil stocks in general? Why would they be donating to him? It doesn't make sense. And actually, the CEO of Occidental, she donated to the new president herself, around $41,300. And it's not the biggest donation ever, but she did donate to him, which means she has some kind of a thesis that, she believes that this is going to be good for Occidental and it's not going to be bad, or else she would not have donated $41,300. It's a very interesting thing that not a lot of people are talking about. And from this article, it says that the new president has promised Occidental better treatment, after the CEO complained that the agency is delaying Occidental's acquisition. And he did promise a more friendly environment in terms of mergers and acquisitions. So maybe this is why a lot of oil companies have donated to him, because they believe that they want to make more acquisitions, and it's hard to acquire other companies. It takes a lot of time. Sometimes they don't get approved, and it's a long process. And maybe he promised them a easier process to do mergers and acquisitions, and maybe a little bit of not as of strict regulation on environmental stuff, which could accelerate a lot of projects for many oil companies. So a lot of oil companies are donating to the new president, and they're not dumb, and they're doing it for a reason. But everyone else, like all investors, believe 2025 is going to be bad for oil, and it's going to be bad for oil stocks because we have that new president that's pro drilling, but all those CEOs, a lot of them are donating to him, which makes it a very interesting setup. So a lot of things could happen, but oil is getting cheap. I'm just being honest. You look at this inflation adjusted chart, it's sitting at the same price it was at in 2004. On inflation adjusted. This is absolutely insane. We look at something else that's very interesting, as a lot of you believe we're going to have, more oil wells and more production. Well, this is an interesting chart of, the break-even price of new wells in the United States. And the break-even price is all over, and it's very high. Around 65, 64, 66, 70. That's very, very high. So oil has to be above $70 per barrel for those new companies that want to drill wells for them to be profitable on them. This is a very, very high break-even. Now you look at the existing wells, it's a different story. It's a little bit lower, much, much lower actually, between 35, 38, 40, 45. So we could say 40 break-even on old oil wells and around $70 break even on the new oil wells. But this is just for the United States. If you look at Saudi Arabia, which is a major player in OPEC, their break even for fiscal break even, meaning, if they want to cover 100% of their fiscal spending by crude oil, and they are very dependent on crude oil so far, they're trying to get away from it, but they're still very dependent on it. They need $96 per barrel just to be break even. So the main reason why I'm showing you this is because I believe, in the United States, if the break even on old oil wells is around $40 per barrel, and it has to be above that. It has to be at least 50 for the companies to be profitable. So will the new president really let oil companies be unprofitable? He did talk a lot about keeping it at a level where it's profitable for oil companies and it's good for consumers. And there has to be some kind of a bottom on crude oil. This is my main thesis. And if the oil wells break even is around 40 to 45, let's say for them to be profitable, some kind of very little profits for the old wells, the new wells 60, 70. So I would say oil has to bottom out between $50 to $55 per barrel for those companies to be profitable and for it to be good for consumers. So I don't believe OPEC and the president of the United States, they're going to let oil go below $55 per barrel because they want their companies to be somewhat profitable. I mean, they just can't let it go lower, and they can control production. And they've been more involved than they were back in 2015, 2016. At least this is how I see it. So if oil could potentially put a floor around $55 per barrel, now sitting at 68, which means we could have some more downside to go, but there could be a near bottom very, very soon. And in my opinion, the closer crude oil gets to 55 or 50, in the 50s kind of dollar per barrel, the more interesting a lot of those oil stocks get. I'm not saying Occidental is not interesting at this price, and they could finally do some buybacks, which is amazing, but I'm saying that there has to be a floor around 55, maybe around 60 even for a lot of the new wells. So I'm saying there has to be a price where they're not really going to let it go below that. And we're approaching this price. We're at 68. If the price is 55, then there's not much downside to go. Maybe 5, 6, 7, 8% on a lot of those stocks. And they could start bottoming out as the market is forward looking, and it could start looking better from here. So this is what I'm trying to explain. Now, looking at the valuation of Occidental, based on the latest analyst estimate, it's trading around a 9.5% free cash flow yield. And this is based on the prices and on latest estimates, which in my opinion isn't the best, but it's still not bad at a 9.5% free cash flow yield. And this free cash flow is expected to increase from $4 billion in 2024 because they had a lot of stuff within the new acquisition, and the new acquisition is going to contribute more in 2025. So free cash flow is expected to expand from $4 billion to $4.9 billion to $5.8 billion. And I'm not really banking on it, but the way I think of Occidental is if crude oil stays where it's staying at right now, I would expect at least an annual return of 9.5% to 10% on Occidental Petroleum, which is mainly the free cash flow yield. Now, if Occidental goes up or if oil goes up from here, I would expect the free cash flow to be a little bit better. So on the low end, I'm expecting 9 to 10% annual return on Occidental. And you have the option of higher oil prices, which in my opinion, from where they're trading at, and if I'm right on that $55, $56 kind of floor, there's more upside than downside from this level. So you could potentially get a 10% annual return from Occidental and the potential upside of more 14, 15, 16, maybe 20% a year if free cash flow goes up with crude oil going up and the company doing buybacks and increasing the dividend, which is going to give it a multiple expansion in the future. This is what I noticed with a lot of the oil stocks. People like dividends with them because the industry is cyclical. And in my opinion, it's getting very interesting. And for my final decision, I would say it's not the easiest stock to analyze. But if I had to look at Occidental, I would say it's a buy. But if ever oil gets to 55, close below $60, it gets much more interesting. Like if I did not own Occidental, which I don't own it yet, I would wait for under $60. I'm just being honest. It would be very, very interesting. If it doesn't happen, then it's fine. And I would expect Occidental from here to return a minimum of 10% per year. And if you have the upside and optionality on oil prices, could go up to 15% per year. So it's getting interesting, and you have to make this decision for yourself. It's a very hard stock to analyze, but it's looking better from here. And I think there's more upsides than downside. And this is all I could say on Occidental Petroleum. I hope you enjoyed it. Not financial advice. If you did, please press the like button and maybe consider subscribing. So I'll talk to you in another video.